Let's go to the pound yen, assuming that is in fact. And again, the RSI, what if you're wondering under what scale, under what criteria does this tell us that the pound yen is the weakest currency? The RSI, I always use again the standard settings, goes back 14 periods. On a daily chart, we could count that 14 candlesticks. And we can manually do so as well. We see the pound dollar at 139.77 right now. Count back 14 candlesticks. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14. We'll take the highest high, going back 14 periods. The pound yen was at a high of 147.21, currently 139.76. Roughly, that's what, 700 something pips. Over the past 14 candlesticks, the pound yen has gone down 700 plus pips. Now, let's take a currency pair that really has a benign or relatively flat RSI, such as the dollar CAD. But dollar CAD right now is 105.97, and we're going to subtract the highest high from the lowest low, give the foreign exchange market the benefit of the doubt. The dollar CAD right now, 105.96, count back 14 candlesticks. So let's zoom in so it's a little bit easier to see. Please let me know if you don't see the dollar CAD chart, by the way. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14. Well, let's take the highest high going back 14 candlesticks was 106.88 on the dollar CAD. By the way, the dollar CAD RSI was almost exactly 50. That's why I picked it, because it has literally no trend at 50, right in the middle. So the highest high was 106.88. Right now we're at 105.94. The difference is what? 88 plus 5, that's another 93 pips. So if over the past 14 candlesticks, while the pound yen has moved 700 pips, the dollar CAD has moved less than 100, 93 pips. In other words, if we had been right to sell short the dollar CAD, and if we had bought the dollar CAD, we actually would have lost the money. That's why I say sell short. Let's give ourselves, the benefit of the doubt. If we were right and sold short the dollar CAD 14 candlesticks ago, we would have made 93 pips. And over the same period of time, if we had sold short the pound yen, we would have made 700. Well, obviously the pound yen, that represents a better trade. Well, from that point moving forward, how can we use this information to our advantage? Well, we're day traders or we're short-term traders. Now, if we're long-term traders, that's a different case. I would like to look at the longer-term trades and, look at the longer-term charts, I should say, support, resistance, fundamental data, a little bit more involved. But short-term traders, well, the first thing we would say is, the trend is your friend. Okay. The trend is your friend. The strongest trend is cable yen to the downside. And we know that we want to trade in the same direction of the trend, and that is certainly to the downside. Well, that means we only want to look for areas to sell short. Let's roll back the clock and say, well, I wish I would have known this was the case. Let's pretend that we did. So we go to a shorter term chart. We go to, let's see what would work well. Let's say a 4-hour chart on the cable yen. On the cable yen 4-hour chart, we want to look for a day trading strategy. So I want to throw in another indicator, something very simple. No pun intended. We'll look for a simple moving average. How do we use the simple moving average in the trending market condition? Well, I just threw in a simple moving average. It happens to be a 60-period moving average. Just out of coincidence, it happens to look pretty good. But we're going to look for a 65. I'll tell you why. There we go. Okay. In a trending market condition, we only want to look to trade in the same direction as the trend. So going back over time, if we would have known that the cable yen was a weak trending currency pair, and I knew at that time that I wanted to look to sell short, I want to sell short as close as possible to the moving average. Well, how do I know which moving average to use? You see this high that occurs up at 147.21. It's on a 4-hour chart. This goes back to January 28th. The high again was 147.21. I want to find the moving average that comes as close as possible to that high without the moving average being too far away, so the high that candlestick doesn't touch the moving average, and not too short of a moving average where the candlestick goes above. Now, this is a 65-period moving average. Now, different moving averages can be used at different times. Let's try to use a 95 moving average. Well, we see if we use a 95 moving average, it's too long of a moving average because the candlestick doesn't touch the moving average. It factors in 95 candlesticks. That's not enough time. Let's say we didn't know 65 was a good number. Let's use 35. Well, 35 is too short because 35, we see the market intersected and actually crossed above the moving average. What we want to do is try to find that perfect moving average where the market touches it but doesn't go above. Well, we know it's a 65. Just out of luck, I happen to get 65. That worked well. Well, if that moving average worked well in the past, I want to trust that moving average for one more trade moving forward. Days from now and weeks from now, will that moving average still continue to be the right moving average? Maybe, but I would say probably not. I think this is a technique that you can use. 4-hour charts, I really, really like to use this technique. I think it's a good compromise between long-term trends and short-term pullbacks. So what I want to do is look to sell shorts, trend is your friend, the next time the market tests and fails to break above this moving average. Well, we knew that this moving average was good at 147.21, highs of January 28th. Then the market went down. Well, that was on January 28th. February 3rd, the market went up again. Now the moving average told us to sell short, to look to sell short. The moving average indicates 145.59. The high of the market was 145.25. Only about 20, 30 pips difference. Not too bad for a 4-hour chart, which tends to still factor in quite a bit of trading volatility. We would want to look to sell short when the market looks like it's going to come up as close as possible, hopefully touch that moving average, but not go above it, and then show its reversal signs back to the downside. At that point, we would want to look to sell shorts with the anticipation of going down. You keep your protective stops above the moving average and take profits. Well, taking profits, you have to do it with a little bit of discretion. There are other tools you can use. I'll show you one in a moment, but that is the basic technique. Is the 65 simple moving average still appropriate? It currently tells us to sell short at 142.43 or at 139.78. I would say no. After that one test, especially if it didn't come up exactly as we expected it to, I want to readjust the moving average again so it comes down and touches the last significant high. So if this is a 65 moving average, go down to a 60, and that does the job. So the 60 moving average now shows us the market going down a little bit at a faster clip, and that shows us at the moment we want to sell short near 142.24. If the market continues lower and doesn't give us a chance, I'll have to readjust the moving average again.